Today, we will find out if REITs that are also Dividend Aristocrats are a good fit for you, and we will begin right now. Two investment avenues that I really love are REITs and, of course, Dividend Aristocrats. As luck would have it, there are some fantastic stocks that fall into both of these categories. A lot of REITs are not so much increasing their dividends every year, so these are the elite few that do that. Investments that only get better year after year. And just maybe, we will see some growth potential in these guys as well. Before we raise those rents, let me know in the comments what REITs you currently hold. Slate Grocery REIT has the biggest share in my TFSA. I am very grateful to see you all here in the home of free financial content on YouTube. If you are new, please subscribe right now so you won't miss a single moment. And a huge thank you for that click whenever investing in REITs. It never hurts to remember some of the pros and cons of REIT investing. The big pros include the high dividends that are usually paid out monthly, being a great way to build passive income. Another pro is that this is one of the best ways to get a no muss, no fuss exposure to the real estate market. That also includes commercial and industrial real estate. They are also much more liquid than actual real estate holdings, which can be a big plus as well. Of course, with pros come a few cons as well. The biggest con is the tax situation. REITs pass on their profits to you without paying taxes on them, thus making them 100% taxable. This, of course, is easily rectified by keeping your REITs in your TFSA or RRSP. Another con is that rising interest rates can impact a REIT's overall value, as their real estate holdings began to incur higher interest on mortgages. As we look at today's list, we are going to see some examples of this. Growth on the stock value can be both a pro and a con. Some REITs are happy to flatline across the charts as they collect their rents, pay their dividends, then rinse and repeat. You still see movement as they go up and down with the market, but overall, these ones just don't grow much over time. There are also REITs that do grow, and you can count on a little bit of growth in addition to the dividends. The best way to know which REIT you have in terms of growth is to just zoom out and take a look at the bigger 10-year chart. That should definitely highlight a growth trend if they have one. In last week's video, two REITs were featured in that list, and they were the Slate Grocery and the Smart Centers REITs. Both are absolutely fantastic REITs, and if I included them, they would be number 1 and number 2 today in terms of dividend yield. So definitely, if you want more information on either of those, I will link that video below in my pinned comment. So, without any further ado, let's get this list started. The first REIT of today is the Killam Apartment REIT with a ticker of KMP.UN. Killam is based out of Nova Scotia, and they primarily invest in multi-residential properties and manufactured homes. They do have properties from coast to coast, and they also have a small amount of commercial properties. They have a pretty solid business, and that may be why they are an aristocrat. Their market cap comes in at $4.89 billion, while they have a beta of 0.93, so they are less volatile than the market average. Their earnings per share comes in at 2.21, and they have a price to earnings ratio of 7.90. In terms of dividends, they have a yield of 4.009% that is paid out monthly in the amount of 5.8 cents per share. With growth, if you zoom out to the 10-year, you can see that this is one of those REITs where you will get some growth. In 2021, we did observe a return on investment of 40.18%. And if you add in the dividends, we saw a total return of 44.19%. Holy banana bread, that is not too shabby. Then enter on stage left the bear market, and thus in 2022. So far, we have an ROI of negative 26.08%. That is really not too good, but yet not unexpected, as rising interest rates and the bear market are not the best combination for REITs. That sounds like one of those cons I mentioned earlier. Our next REIT is the Granite REIT with a ticker of GRT.UN. They are based out of Toronto, and they primarily invest in industrial properties throughout North America and Europe. Most of their revenue is rental income, and their biggest tenant is Magna International, which is an automotive parts manufacturer. Their market cap comes in at $2.03 billion, while they have a beta of 0.86, so they are a good amount less volatile than the market average. average. Their earnings per share comes in at 16.79, and they have a price to earnings ratio of 4.40. In terms of dividends, they have a yield of 4.149% that is paid out monthly in the amount of 25.8 cents per share. Zooming out to the 10-year chart, you can see that this is a REIT that very much likes to grow. In 2021, we did observe a return on investment of 39.18%, and if you add in the dividends, we saw a total return of 43.33%. Enter the bear market in 2022, and we have an ROI of negative 29.38%. Like Killam, Granite is following a pattern we are going to see again today. Our next REIT is the CT REIT, with a ticker of CT.UN. They are based out of Toronto, and they are a REIT that primarily holds the properties for Canadian Tire and also Mark's Work Wearhouse. This relationship with Canadian Tire has really made this a pretty stable REIT, and obviously an aristocrat. Their market cap comes in at $1.78 billion, while they have a beta of 0.95, so they are less volatile than the market average. Their earnings per share comes in at 1.62, and they have a price to earnings ratio of 10.30. In terms of dividends, they have a yield of 5.222% that is paid out monthly in the amount of 7.2 cents per share. Zooming out again to the 10-year chart, this is another REIT that likes to grow. In 2021, we did observe an ROI of 14.19%, and if you add in the dividends, we saw a total return of 19.41%, lower than the previous two, but still not too bad. With the bear market in 2022, their ROI is negative 4.37%. That is actually not too shabby, as CT REIT has shown a stability we have not seen so far today. Our next REIT is the Allied Properties REIT, with a ticker of AP.UN. They are based out of Toronto, and they are a REIT that primarily holds urban office environments in major Canadian cities. Their clientele includes IT firms, banks, governments, marketing, and communication firms. Their market cap comes in at $4.09 billion, while they have a beta of 0.97, so they are a wee bit less volatile than the market average. Their earnings per share comes in at 4.27, and they have a PE ratio of 7.50. In terms of dividends, they have a yield of 5.479% that is paid out monthly in the amount of 14.6 cents per share. Zooming out once again to the 10-year chart, this REIT had a history of growth, but the pandemic and bear market has done a good job hiding that point. In 2021, we did observe an ROI of 19.24%, and if you add in the dividends, we saw a total return of 24.72%. With a bear market in 2022, their ROI is negative 27.25% so far. So they are showing the same pattern we saw with Killam and Granite. However, their current price of $31.93 is just a few cents above where they were priced 10 years ago. Just before the pandemic, they had peaked at $60.14. So yes, they are still recovering, and that could be some great growth opportunity on the other side of the bear market. Our next REIT is the Chartwell Retirement Residence, with a ticker of CSH.UN. They are based out of Mississauga, and they are a REIT that primarily holds, manages, and operates long-term care homes from coast to coast. This is a sector that is in high demand and will continue to be so as the baby boomers move deeper into their retirement years. Their market cap comes in at $2.46 billion, while they have a beta of 1.18, so they are actually a wee bit more volatile than the market average. Their earnings per share come in at 0.08, and they have a PE ratio of 136. That's a little high, and that could be concerning. In terms of dividends, they have a yield of 5.851% that is paid out monthly in the amount of 5.1 cents per share. When we zoom out to the 10-year, this REIT has seen some growth, and they are more than likely to see more as the demand for long-term care centers goes up. In 2021, we did observe an ROI of 12.81%, and if you add in the dividends, we saw a total return of 18.66%. With the bear market in 2022, their ROI is negative 12.02%. This is not too bad. I do think they are poised for some solid growth on the other side, well, of the bear market. With these Canadian Canadian Dividend Aristocrat REITs, we have seen a familiar story with some growth potential and reliable dividends. There really isn't a lot of great concern with any of these. These are some solid, safer choices than a lot of the REITs that are out there. The big thing, of course, is to have patience on growth, as the rising interest rates will slow down the recovery for a wee bit, but they will get there. The fun does not have to end here, because you can always watch my video on Air Canada that I've linked on the left, or you can check out the video on the right that YouTube thinks you will like a little bit more. Your click will decide who is right, and I will see you in the next video.